will be focused on the standard of revenue, IFRS 15. IFRS 15 is a standard set out to establish the principles that an entity shall apply to report the useful information to users of the financial statements about the nature, the amount, and uncertainty of revenue and cash flow arising from contracts with customer. So that is the objective of revenue. So given the objective of revenue as explained, the big picture is, first of all, how do we recognize a revenue? So to recognize revenue, we use a 5-step model, which is the step 1, the step 2, step 3, step 4, and the step 5. So step 1 is that you have to identify the contract with the customer. So a single and combined contracts, and then there's modifications of contracts, issues that we consider. Step 2 is that you identify performance obligation, which are goods and services that are distinct. And thirdly, we determine the transaction price, and you have to consider issues such as variable and non-cash considerations and time value of money. And then we also have to allocate the transaction price to the performance obligation. So we allocate it on general accounting tool using standalone prices. And then step 5, we recognize revenue when the performance obligations are satisfied. So what we have to consider is control of assets in the transfer. But first, we need to define what revenue is. So revenue, first and foremost, is an income. But what kind of income is revenue? So it's income that arises from the course of an entity's ordinary activities. So if I put an example, if you are a cell phone operator and services, your normal services is that you are providing data, you are selling handsets. So revenue arising from that is revenue from your ordinary course of business. But what if you could now sell the building where you are conducting your business? So that kind of income that you would receive from disposal of that building wouldn't be income that is arising from your ordinary course of business. So revenue also, we talked about its recognition. Now let's look at the steps and what each of the steps assist us with in accounting. So step 1 and step 2, they assist us in the recognition of revenue. How do we recognize revenue? Step 3 and step 4, they assist us in the measurement of revenue. So how do we measure revenue? By determining the transaction price and then allocating the transaction price to using standalone prices to the performance obligation. Those steps, they assist us with the measurement element of revenue. But then we've spoken about the fact that step 1 is that you recognize, you identify a contract with the customer, but we have to start to unpack what is a contract. So what a contract is an agreement between 2 or more parties that creates an enforceable rights and obligations. So there's rights and obligations. And what is a customer? A customer is a party that has contracted with the entity to obtain goods or service that are an output of the entity's ordinary course of business in exchange for consideration. So a customer contracts to receive goods and services that are an ordinary course of entities' businesses, and we said an ordinary course of entities' businesses, income arising from that is what? It is revenue. And then we said customers then, they receive those goods or services in exchange for a consideration. That's what constitutes a customer. So an entity shall account for a contract when all the following criteria are met. The parties to the contract have approved the contract and they are committed to their respective obligations. The entity can identify each party's rights regarding goods and services to be transferred. The entity can identify the payment terms for goods and services to be transferred. The contract has commercial substance. Remember when we said that a customer agrees to receive these goods and services in exchange for what? For a consideration. So there is commercial substance, and it is probable that the entity will collect the consideration to which it is entitled to. If one is not met, consideration received is equal to liability until all criteria are met. So if you receive consideration, but one of the elements above are not met, consideration that is received is a liability. A contract does not exist if each party has a unilateral enforceable rights to terminate a wholly unperformed contract without compensating the other. A contract exists if rights and obligations in the contract are enforceable, then revenues should be recognized. Now, step 2, we said it's identifying a performance obligation. So, at the inception of the contract, an entity shall assess the goods or services promised in a contract with the customer and shall identify as a performance obligation each of the promises to transfer goods. In our example, we shall have a network operator that promises network services monthly. So these network services, a customer, network services such as provision of data, they can purchase these separately, but in this contract there's this bundle of goods and services that the customer will receive. But also, we say, shall identify as a performance obligation each promise to transfer to their customer. So also if you're going to also give the customer as a network provider a handset, so each of these promises, the data provision that you're going to give the customer, but also the handset, those promises are your performance obligation. So a good or service that is distinct, or a series of goods or service that are substantially the same and have the same pattern of transfer. So you can transfer a good or service that is distinct, a handset is distinct from network services, or a series of goods and services that are substantially the same and have the same pattern of transfer. You are transferring these services every month and they are the same, and they also have a similar pattern of transfer.